When will debt levels in the United States become unsustainable? This is the trillion-dollar question that everyone is asking because it's never been done before. The last time that the United States had debt to GDP above 100%, similar to today, was post-World War II, and that was after fighting a successful war, after which the United States came out as the strongest nation with the majority of the world's gold reserves and such, and industrial base. So it was a very different situation. Inflation did run hot afterwards, but you had massive productivity growth. The other situation to compare with is the 1970s, which actually isn't comparable. So in recent memory, we haven't had a similar situation as what we're facing today, because in the 70s, you had actually low debt to GDP ratios, which is why Volcker, the Fed chairman at the time, was able to raise interest rates so high, and sustain it because debt levels were pretty low. This way, he didn't have to worry about the government having to ratchet up its interest payments and having an unsustainable budget where the majority, if not all, of federal budget went to pay for interest on the public debt. So let's go down a thought experiment for what might happen. Again, this has never been experienced in our lives for a country like this with the world's current reserve currency. But let's begin this thought experiment and just explore what might happen. So first of all, we agree that the de-dollarization and the dollar losing its reserve currency status is probably far off. But it is being chipped away at in our faces, and you see it obviously out there. So one of the first factors is because the US has weaponized its currency regime. So for example, after the Russian invasion of Ukraine, suddenly all of their euro, US dollar reserves were gone just like that. And of course, sanctions have been around for a long time. So as you can imagine, as the world is deglobalizing and splitting into different blocks, countries, many central banks along the world who aren't part of this Western alliance will seek to have different types of reserves other than the US dollar, which are traditionally parked in treasury bills, bonds, and such. So they'll seek alternatives, and which is why gold is receiving such a bid due to central bank buying and such. So these things are happening right around our edges. Historically, China has, for example, been one of the biggest buyers of treasuries. Their holdings over the past few years have steadily declined, so that demand is going away. You also have the phenomenon of, at least right now, quantitative tightening. It's not going very fast, but the Fed is no longer a massive elephant in the room of buying treasuries, so that demand is gone as well. So on the one hand, you have less demand for treasuries. We just talked about the demand for treasuries being less from central banks, especially central banks of countries like China, Russia, even of the global south, as they seek to diversify away from the US dollar because they're afraid of it being weaponized against them. So there's less demand. There's temporarily less demand from our own central bank as well because of quantitative tightening. And on the other hand, supply is only expected to increase, right? So the US runs twin deficits, so a current account deficit and a fiscal deficit. So every year, I believe it's approximately $1 trillion that we have a fiscal deficit. So the government borrows $1 trillion because the revenue that the US raises via taxes and such is less than the spending by $1 trillion. So that's the fiscal deficit that we continuously have. And then the current account deficit is us, the United States, importing more than it exports. So these are twin deficits, and these essentially increase the supply of treasuries because the government needs to fund these deficits by borrowing. Well, as we've just discussed, if you have less demand, structural demand for treasuries, for US government debt, but you have increased supply for the foreseeable future because of our spending habit, yields would probably go up and prices go down. So the interest rates across the spectrum for treasuries are then only logically expected to go up. Now, medium to long term, the Treasury or the Fed cannot allow this to happen because a non-official mandate besides price stability and employment is actually keeping the government funded and afloat. Due to the extremely high debt levels that we currently face, if interest rates are allowed to reset at a higher percentage, say 4 or 5%, it would eat up more than what we spend on defense and pretty soon the entire federal budget. So obviously that can't be allowed to happen. So the Fed ultimately has to intervene. I mean, there are two ways to address this, right? You either raise taxes, which are kind of essentially tapped out, or the central bank prints money by buying these treasuries and thus capping rates and keeping rates low. And which is why we believe that the most interesting phenomenon to watch in markets today is what's happening in Japan and with the Bank of Japan specifically. So as you may be aware, Bank of Japan, the Japanese essentially have been the pioneers in this sort of quantitative easing, zero interest rates for the longest time since their epic bubble burst in the late 80s, early 90s and such. They've been at it for longer than the rest of the developed world has, and now that seems to be finally breaking because they've been propped up as an example for the past decade of this abnormal zero interest rate policy by saying, hey, Japan has this, even higher debt to GDP ratio, and they are still, nothing bad has happened. So it's going to be extremely interesting to see because, in the last year, they instituted yield curve control, which we saw in the United States post-World War II as well, where their central bank says this is where interest rates can be at a maximum level. So they just raised it recently, 25 bips to 50 bips, in an admission that the market is not believing them and really pushing back. And basically what they do to enforce this maximum yield curve, for example, the 10-year, they say the maximum is 50 bips, 25 to 50 bips. They essentially have an unlimited QE policy. So the central bank buys an unlimited amount of their government bonds to cap yields at that rate that they specify. And as you can see, what's happened in Japan over the years is because they've kept doing this and doing this, they are the biggest buyer, I believe over 50% of all Japanese government bonds. So they've become basically a whale in that market. They are the biggest factor in the market. But what's so fascinating to watch is you can see the cracks starting to form in their attempt to keep yields capped. So recently, just this year in 2023, they've announced an increase in their maximum allowed yield curve. So it's increased slightly, 25, 50 bips. And you can see that the market is actually pushing up against that cap because it's disbelieving that they'll be able to hold it. And that's also because what ultimately happens is, when you suppress interest rates, and especially relative to other central banks in the world, you eventually cause inflation. So, and you're finally starting to see it in the Japanese economy, and this is an economy that is unique in its own respects for having a high savings rate, low population growth and such, aging population. So they've had various deflationary trends for a long time, but by keeping their currency very weak, and because their rates are so low and unattractive, you see that, at some point your very weak currency is going to cause inflation, if nothing else, due to higher import prices. When you buy from abroad, your currency is weak, you're going to be paying higher import prices. Eventually, that does feed into inflation. They're seeing it now. It's reasonable by our standards here, but say like 4% is quite high for them. So it's going to be very, very interesting to see what happens and how they deal with this conundrum that they're in. And it is quite a conundrum because if you think about logically what happens, if inflation goes up, what can they do? I mean, if they raise rates, sure, they can keep raising rates to try to fight inflation, but because of the extremely high debt levels, you can't raise them too much because if you do, then the interest payments on your own debt become unsustainable. So then, it's going to be very interesting to see what happens because then, perhaps what they do is let inflation run hot, try to have inflation burn away the debt in real terms. But in order to do that, they need to keep nominal interest rates high because the market's going to push their yield curves higher. So their only option to try to keep the debt affordable for their own government would then be to continue basically financial repression by having the central bank continuing to buy unlimited amounts of government bonds to keep yields capped. So their nominal rates are capped so they can keep their debt affordable. unfortunately you're going to have higher inflation. And then the question is, in this unprecedented experiment by central banks worldwide, in the developed economy in particular, what happens, right? So they're already greater than 50%, the central bank is, of all of the entire Japanese government bond market. What happens if they keep doing it? What if it gets closer to 100%? At that point, the question you ask yourself is, what is the difference between that and Zimbabwe, where the central bank is financing, the vast majority of all purchases of government debt, and you're basically having the central bank fund your current account or fiscal deficit. I mean, at that point, my only logical conclusion of what would happen is the currency would become worthless, and then you would actually have that hyperinflation scenario that everyone, believes is so far off and is perhaps a conspiracy theory, but it has happened in history. Many currencies, or I'd say perhaps most currencies, or the vast majority of currencies, if you look at a long enough time span in history, have gone to zero, and for this reason. So what do we think will happen? Well, of course, in the medium term, in a situation like this where you have inflation raging, and we saw this in 2021 as well in the developed world, stocks are going to do well at first because, there is ability for them to pass on higher prices to consumers and such. But be very careful, because in the long run, when these problems accumulate to the point where, we say, hey, it gets to a point where they are, 80, 90%, or some significantly higher percentage than 50% of their government bond market, what happens at that point is, as you experience higher and higher inflation rates, then stocks also eventually go down, just because of the huge economic troubles and dislocations in the market you see. And for example, you see that in Argentina, as you have very, very triple-digit rates of inflation, it becomes harder to conduct business, transact. Stocks ultimately do go down when that happens as well. So these are all very important things to consider. There is no set answer, because something like this has never been, in modern history at least, been seen before. It has happened historically, but it's going to be very interesting to see. I mean, the US currency is a reserve currency. We have the risk-free rate, but the problems that we have with spending, with the deficits, basically the current account deficit and the fiscal deficit, and future less demand or reduced demand for treasuries due to a variety of things that we see happening in public. This is going to be interesting to see what happens. I mean, yields are probably going to rise unless we have intervention, and we're probably going to have intervention because ultimately the Fed wants to keep rates low and affordable for the government debt load interest payments. So it's kind of a catch-22. So we'll see what happens. I mean, basically it's a circular method, because as you do that, then inflation goes up, and you have to, and yields would go up unless you intervene more. So you have to buy more, and the Fed has to buy more, blow up its balance sheet more, and become a bigger percentage of holders of the public debt, until who knows what happens, until, let's see, like Japan is the monetary experiment of the day, and it bears, you should really watch it very closely to see what happens, because as they get higher and higher, something might eventually break. And of course, keep in mind, there's always going to be people who tell you, hey, like, don't worry, we can, you have the MMT people, folks who believe in MMT, that you can print money for nothing, basically. You can keep doing it because, hey, nothing bad has happened yet. We like to use the example that this is the same argument as falling off a building. You're looking up and you're like, hey, everything seems fine so far. Everything seems fine, until something happens and it's not. So this is some food for thought. Again, we're not saying that there's, hyperinflation or anything coming up soon. That's often dismissed as a conspiracy theory. But again, fiscal irresponsibility is something that bears watching. Japan has a zombie type, bizarre type of, they are on the leading edge of monetary intervention. So it's going to be very interesting to see what happens for a developed, advanced economy with one of the minor reserve currencies, to see what happens to them. And then hopefully we learn from that and make sure it doesn't happen in this country. My name is Chris at Hauseit, and we hope to see you on the next one.